Very interesting trends, not just internationally, but here in India as well. We've got Latha joining us on the show today. Latha, thank you very much for taking out the time and joining us on Who Moved the Market. It's bond yields that seem to be moving the market today.
Oh, absolutely. Actually, bond yields have been falling for some time now, and today they got an extra fillip from the global factors. The Fed, of course, raised rates, but that key sentence was missing, which was that we think more rate increases will be appropriate. That sentence was missing, and it was more like rate increases will depend on inflation, labor. It was there in a very subdued form, and the market has therefore taken it as perhaps one and done, and no more rise. But there is a section of the market which believes there could be one more. Anyway, the bottom line for the market is the expectation that there won't be hikes. Now, the Fed has said that they will perhaps get away without a recession. There was a very clear statement saying a soft landing is not off the table. And, there is as much of a chance of the economy managing without a recession as there is of a recession coming. So actually it was positive, but the markets interpreted the fact that the Fed is stopping as fears that the Fed is worried about the slowdown in economic growth. So that has also pushed crude prices down. All that is also beneficial to bond prices in India. It would mean inflation will not be that big a threat if crude falls and if there are recession fears. So both the fall in yields as well as the fall in commodity prices is helping the bond situation today in India. But that's today's story. The bond fall story began earlier.
Absolutely, and I just want to get to that. But before that, quick question on the global picture. Over the last, I think, several weeks now, we have seen U.S. bond yields also become fairly tame. They've been falling steadily. I think they fell to about 3.3 yesterday after the decision. The dollar has been falling. So is that the global narrative that we shouldn't expect any surprises, at least on the yield front or the dollar front?
It's not at all so unambiguous. I mean, it is pretty two-sided. The Fed also did not rule out completely a rate hike. They merely said that, this is a meaningful change in our statement, the removal of the word increases.
And they kept talking about inflation as well in the commentary yesterday.
They specifically said it is still sticky and our goal is to come down to 2%. Until then, our work will not be over. So they have not ruled out another hike. And it is sensible to be data dependent because you're not very sure about how the labor market data will come out. At the moment, the Fed pointed out that labor market has started to show some softness. Wages are not rising. And that itself is an indication that there's some softness. Also, the US GDP print came in softer than expected. They were expecting 1.8%. It came in at 1.1. So clearly some softness in growth is visible, both in growth and in the labor market, more importantly. But who is to say that inflation can remain sticky? Usually these rate decreases first impact growth and impact inflation a little later. It's quite possible that we will be saddled with that kind of a situation when growth is clearly showing signs of a fall, but inflation isn't falling. So another rate hike can't really be ruled out. Therefore, I won't go that far, but clearly at the moment the signs are that both inflation and growth are falling.
Okay, well, that's the global backdrop. Now coming to the India picture, as you mentioned, the fall in yields here, it's not entirely linked and only because of this overall fall in the US 10-year, right? So why is the Indian 10-year falling so much? As you were telling us, it fell below 7%, I believe, today morning.
Yes, there was a trade below 7% and then it stabilized at 7% in the morning and has then inched up as the government auction took place. It's a massive auction of nearly 20,000 crores. So there is bound to be some jitters in the market because of the auction. But the point is, there are several positives. We've been falling from March 1st. And first, the signs came when the US yields itself fell in March. And then in April, the RBI, there was an unexpected pause when people were expecting a hike. And of course, crude prices lately have been falling. So that's the broader picture that's helping yields fall. But the bigger one is the manic buying in government bonds, which people were they were aware that it will come, but perhaps the proportion was underestimated. One big reason, HDFC twins. Now, HDFC on the day of the merger, which may be July 1st or August 1st or something, on that day they have to be SLR compliant, which means
they have to have a certain
22%
of
of the new money that comes in, the HDFC book, will have to be invested in government securities. So they are buying government securities till their face is blue, and so is HDFC. They're also raising money, long-term money, and they've invested it in a substantial part in government securities, so that on the day of the merger, the bank doesn't have a problem. That's one big reason why you're seeing a pressure on bond yields. The second one is insurance companies, which you know best. You know, in the budget, the government, on 21st February, everyone knew that over 5 lakh premium will not get tax benefits.
Yeah.
So that would kick in on April 1st.
Correct.
So that month, February and March,
huge buying of these policies.
Huge buying on this, policies. And those are all, life insurance policies. They have to be invested in government securities. Everything couldn't be done by March. So a lot of it is happening in April. That's the other reason why today yields are almost 45 basis. I mean, half a percentage point lower than what they were on March 1st.
Okay, I guess the borrowers would be quite happy, which is why we're seeing a nice little rally play out in a lot of the NBFC stocks today, given that in general, perhaps at least for now, it seems to be a signaling sign that, the big peak in terms of rates and yields perhaps is behind us. But that's really my, final question. You talk to people across the board in the market. What is the sense? Is this just a sort of a short-term blip because of this huge demand? But then the HDFC demand itself could be pretty massive over the next couple of months, right?
Well, you actually hit the nail on the head. This is a bond market phenomenon, and markets are fickle creatures. So there could be a hike in crude prices. Government borrowing is substantial. I mean, every week that level of borrowing is going to hit the market. I'll tell you the exact borrowing on this auction itself, today's auction. It's about 30,000 crores that the government has borrowed, and they're going to borrow that week after week. So there can be an upward pressure on yields because of a whole host of reasons.
All the supply that's going to be coming.
There could be. Supply is there, as well as, and the HDFC demand may run out by probably July or something. And the insurance demand also will run out. It's only the excess policies that they've accumulated. Markets are fickle creatures. The second point, so therefore, those who are borrowing from the market are benefiting. NBFCs. So today, as you will see, the entire NBFC lot, Chola, of course, because of their results, up 7%, MMFSL up 6%, GIC Housing 4.8, LIC Housing 3.2, Bajaj Finance 2.7. I mean, I could go on. All NBFCs are the ones who keep tapping the market for, paper, with their paper, and that's the ones that's benefited. But by the time this competition seeps in and banks lower their loans, banks are tied to the repo rate or something, but they can change the spread over the repo rate. They will do that if the bond market competition is too much. They're not doing it just yet. If the bond yields remains mellow for a goodish bit, then banks will lower. And then you can see other sectors also getting advantaged. So at the moment, it's a little too early for everyone to get
start rejoicing.
AAA companies and NBFCs immediately have a benefit.
Okay, but perhaps the sense is that this is equilibrium zone, somewhere around the 7% mark?
At the moment, people think it's a flaw, but it's a flaw. It's difficult to see it. 6.9 something is the market's opinion.
But will they race back towards 7.4?
7.4 looks unlikely.
It's a long cry. It's a long cry.
7.4 looks a little tough. Because GST collections have been good. There is no sign that the government is going to borrow more or do anything.
Right. And crude prices have cooled off significantly.
So at the moment, there's no fear that it'll go back there. I mean, unless there's some unusual program announced ahead of the elections to woo. Those are things that we can't...
outlier events, really.
Outlier events in the crude market. But at the moment, given that everyone's talking about a slowdown globally, it is unlikely that crude will spring such a surprise. So bond yields will see an upward pressure from 7, but it might be well within 7 to 7.1. No one's talking of even 7.2 right now.
Okay, I think the market will probably, at least the borrowers will take it with both hands, because we've seen
NBFCs for sure.
Absolutely, because we've seen those yields shoot up consistently for the better part of, I think, the last 12 months or so. Thank you very much for explaining all this to us, Lata, and you make it very simple and straightforward to understand. So we really appreciate it here on the show.
Thank you.
All right, that's a wrap on this edition of Who Moved the Market. Do keep sending us your feedback, your comments and queries. We'll see you with another topic, another theme tomorrow.